All right, guys, let's start on chapter 9. So we're going to go between current and long term liabilities. So, current is just, we're going to talk about things that are due within 1 year of the current company's operating cycle. And long term is something that's going to be due outside of the 1 year in the operating cycle. So, sometimes we have some uncertainties and we have to figure out how much we have to pay them. We're going to have to record. If there is uncertainty, we have to figure out if we even need to record them or not. These are our known liabilities. We've recorded these already before: accounts payable, sales taxes, unearned revenue, notes payable, our payroll obligations, and then some of these multi-period known liabilities. All right, so we have our sales tax. We have to record the cash that we receive. We always have to record the full cash that we receive, but part of that is our sales, and part of that belongs to the taxing agency. So we have to account for that as a liability because that's not our money. We have to put it on our books and it's a liability, so we can pay that to the taxing agency at a future time because it's not our money. We have to account for it in our deposit. All right, unearned revenue again. We've recorded this before, so we're going to record this when we receive our cash to make sure that our bank balances, and then we can record part of the revenue when we've actually performed the services or we have sold the products when it's actually time to record the revenue. Short-term notes payable, it's within a year. All right, so sometimes we can borrow from a bank or an overdue payable. We've done these where we've reclassifying here. We're going to reclassify from an accounts payable to a note payable. We're the actual vendor here. We're the one that's actually bought the product. So we couldn't pay our bill, and they're allowing us to go in and pay over a longer period of time. We've given them some cash. We're moving our accounts payable to a note payable, and it's going to have 12% interest at 60 days. So it's going to have the same formula that we've used before in 241. For the interest expense, the 12%, 60 days over our 360-day bankers year to find the interest that we pay them at the expiration of the 60-day note. We borrow money from a bank. We'll set up that with a deposit to our bank account. I told the class the other day that most of the time this doesn't look this way. We're going to borrow money and they're going to give it directly to the person we're buying the equipment, property, whatever from. But in this case, we're borrowing money, they're putting it in our bank account. So that's the asset associated with the liability. And then when we pay this back, we have the same formula here for the interest expense. All right. If you guys remember at the end of 241, this is the issue we have. If the note extends over 2 accounting periods, we have to accrue the interest that was due. It wasn't paid, but it was due at the end of the accounting cycle. So in this case, we have 15 days of the total 60 that was due at the end of this accounting cycle. So we have to come up with our accrual, calculate our accrual here for 15 days, and record this at the end of our accounting cycle cutoff period, which is December 31. So when the note is due and payable on February 14th, we are going to calculate the remaining 45 days, pay our payable, give them their full principal back, and then give them the full amount. This $40 would have been the full 60 days, but because it went across 2 accounting periods, it's broken out on our books because we had already set up this expense and payable in the previous accounting cycle. All right, payroll deductions. If you guys remember to start with, when we go through and do this, if we had payroll and salaries, it would have just been a debit to salaries and a credit to either payroll, salaries payable, or a credit to cash. But that's not how it normally works. We have to take these taxes out of our employees' check. All right, 6.2% for Social Security, 1.45 for Medicare is the same all the time. Okay, unless we hit this cap for 2020, it gets higher every year. It's indexed every year. 1.45, there is no cap for Medicare. It's all wages. All right. Federal income tax, state and local income taxes, they're going to give us these amounts. There's a schedule that we go to look for those. But for our purposes here, they're going to give us these amounts. Any other voluntary deductions, insurance, pension contribution, union dues, they're going to give us the amounts we have to take out. Okay. These are our employee amounts. This is our employees' money. All right. If we looked at this entry here, if it weren't for these amounts, we would just give our employee $2,000. So when you think about this, remember this is our employees' money. As you do this in practice, if you do this when you're working for a company, make sure these taxes are paid. All right. The IRS calls these trust fund wages because this is you're holding somebody else's money in trust to remit to the IRS or to somebody else's um, some other program, whether it's insurance, whatever, in trust that you're going to pay it. It's a really quick way to get in trouble by not paying this. Okay. This is our net check. We've taken all these taxes out, the 6.2, the 1.45, the amounts given to us for federal taxes, state taxes, anything union dues, all this stuff is given to us. This is a net check that we actually would write to our employee. The Social Security and the Medicare taxes, the employee, the company, the employer, the company has to match. Federal and state unemployment taxes, those are also in company cost. So when we calculate this, it's 6% for federal and 5.4. It actually could vary in each state, but for our purposes, we're going to use 5.4 for seven. Unfortunately, Alabama is not 7,000; it's 8,000. All right. So we're going to calculate this rate here. These are company costs. This does not affect our employees' checks. This is an additional expense for the company. This is an additional cost of our employees to us. So we would make this journal entry this way. When you calculate this amount, this 6.2 and this 1.45 should be identical to the amount that comes out of the employees' checks. If it's not, go back and use that as a check figure. If it's not, then you've done your calculation wrong. These are matching amounts; they should match. All right. These other amounts here, the state unemployment and federal unemployment, are additional costs we have for our employees. All right. These internal controls, it's good to have these amounts separate. That way you have the right people that are, if you're hiring, you don't have any idea about how much necessarily the salary is going to be or the payroll amounts are correct, that you can't have somebody hiring, giving them an amount of payroll, and then somebody else paying them a higher amount if they know them somehow or putting the wrong amounts in for payroll. And that the timekeeping things are done electronically as well. All right. Unearned revenues, subscription revenues might be across several periods. All right. All right, warranties and bonuses. Um, so for vacation, we're going to have to maybe accrue how much vacation they're going to be able to take out. And we'll have to take it as employee benefit for medical insurance, how much we have to contribute to each one of these. These are straightforward deductions. They're going to give us these amounts too, but it's 10% of the program is what we're going to have to contribute to the pension program. Okay. Vacation works the same way. We have to contribute how much vacation pay they're going to get. All right. All right. So warranty, this is something we do to make sure that our matching principle stays intact. What we're going to end up with here is really is in the automotive industry. Okay, this is something that kind of keeps my head in the same space about this. Is I don't want to sell the vehicle in one year and have all the warranty costs in another. So I'm going to estimate if I sell a vehicle in year one, how much expense will I have throughout the life of that vehicle's warranty, and I'm going to go ahead and record that expense now. That way I have the warranty, the sale and all the warranty costs, all my expenses in the same time period. That makes sure that I keeps my matching principle intact. Okay. So I have the warranty expense here. It says I have a car that sells for $16,000. All right, and I'm estimating that based on past experience, I'm going to have 4% of the car selling price. So I have $640. I'm going to record that now as the expense, and I'm setting up this. It's like a reserve account. I'm using that to hold its place as this liability that I'm going to say that, hey, somewhere in the future, I could have this $640 that I'm going to have to spend in warranting this vehicle. So the next year, the next month, 2 years down the road, I could incur $640. So in this case, it says $200 is what I'm going to have that comes out that I have to actually pull parts out of inventory to warranty some of this car. I don't show the cost again. I don't show the expense again because I already showed it in December when I sold the vehicle. So I'm using this liability, I'm reducing the liability to pull the parts out of inventory. All right. Contingent liabilities are things that are dependent upon something else to happen. So it's something that I maybe a lawsuit that I think is out there that I know that something possibly could happen. All right. But I don't really know if it's going to happen yet or not. We may or may not even have to record this yet. Most of the time this goes in the notes to your financial statements. A lot of time that's enough. This is a situation where don't say too much. All right. I've been involved in cases before where the company would say, we estimate our losses to be $50 million, but they actually only told the settlement they had offered at the time was only 10 million, and it cost them money in the meantime. Okay, so a lot of times we can just say we're currently involved in litigation because of this, and that's enough. That's all you have to say. All right. All right. Uncertainties for other events could be something like environmental problems. Okay. All right. Here are the payroll reports that we use. I even refer to a lot of times the Social Security, Medicare, and federal withholding is 941 taxes because that's the form we file it on. The IRS 940 is what we use for federal unemployment. Alabama's is a UCC R4. W4 we talked about is how you withhold information, how you tell your employer how much taxes to take out of your check. Corporate income taxes. Um, this is a kind of a circular calculation because of some timing differences, mostly with depreciation and other deductibility items. That sometimes you don't have to pay all the taxes that you based on your net income, and your taxable income is different. All right, as always, guys, email me if there's problems, and as you're working through the homework and kind of work on chapter 10.